Within the trade plan, we have money management, or you might hear it more commonly as risk management. Um, and so I mentioned that the trade plan is the most important part of trading as a whole, and I will certainly say that money management is the most important part of the trade plan. And so the goal here is to define or limit ourselves to only risking a certain amount of money on a single trade. There's no universal answer here. Strategies should be tailored to each person. It kind of depends on their resources. It depends on, how many different things you're spread between. And so there is not one single answer. I can say in general, you really should not risk more than 1 to 3% on a single trade. And I would say that for beginners and people that are learning, just stick to 1%. It's lower risk. You can do more trades. It still lets you have money invested in it. And moving up to 3% for really experienced traders, and I do mean that kind of as the top end. um, there are some extreme examples where risking up to 5% on a strategy, that can be okay once it is proven to be very profitable. You are super certain about it, and it's only for the people once they become extremely comfortable with the strategy as well as trading. um, And, at face value, these smaller percents don't sound like a lot, but it adds up really, really quick with some proper trading and a good plan, and the growth comes quickly with this. Um, and along with that, as your portfolio grows, your risk also inherently grows. And so, quick math on that is that let's say your risk strategy is 2%. That's what your trade plan is set to. If your portfolio is $1,000, you would risk 2% of that, which is $20 per trade. Let's say that you are a successful trader for some time and you've now gotten your portfolio up to $3,000. Your trade plan hasn't changed at all, and you're now risking $60. And so the trade plan inherently scales with you based on compound growth. And so as your portfolio grows because you're successful, the risk that you're taking per trade monetary wise goes up, even though the risk isn't any larger. And as you're taking those larger risks, you are able to, make more profit from your trades. And so that kind of escalates itself. And so once the growth starts to happen, it does come in pretty quickly. One thing that I do think is certainly worth mentioning, because I've had a lot of people ask me about this, a lot of people say, if you're only risking 2% of your portfolio on your trade, how are you ever, making that? How are you making life changing money? How does that happen? That doesn't make any sense. You need to put more money on it than that. And that's just a misunderstanding between, saying that you are risking 2% does not mean you are only putting 2% of your portfolio into a trade. It means you're only willing to lose 2% of your portfolio if the trade fails. And so let me give an example on that. And there's going to be some words in here that some, very fresh beginners are not going to be familiar with, and that's okay. You don't need that to understand the concept of this. And so let's lay the groundwork first. Imagine you have $100 in your portfolio, and your trade plan allows you to risk 2% per trade. And so the thing that you want to buy, the asset, let's say that you want to buy it and it's trading at $50 per coin, per share, whatever unit you want to use for this. So whatever you want to buy is trading at $50. You do your charting and you analyze the trade and think that the asset's going to go up to $55. And so you set $55 as your price target for where you want to sell. And based on the charting you've done, you think that the price actually falling below $49 would invalidate your trade. And so you set that as a stop loss. And so that essentially just means that, if the trade hits $49, what you were looking at before is no longer, you're no longer confident in it. And so it hits $49 and you say, you know what, my price target of 55 is gone. I want to sell out of this. And so in this case, the asset falling from $50 to 49 would actually be a 2% drop in that asset. And so I did make the math a bit easy on this just for this visual, that 2% drop in that asset price happens to overlap with the risk tolerance of your trade plan of 2%. And so based on this exact trade, you would actually be able to enter this trade with your entire $100 portfolio. But it requires that you stick to your trade plan. And so let me give a quick summary of what this looks like again in kind of different wording, just to give the main points here. The thing you want to buy currently costs $50. Your target price for it is $55, so that's a 10% increase. And the price that you think this trade has failed is $49, so that's a 2% decrease. And so if you entered this at $50, your 2% risk trade lets you put your entire portfolio into it. And so if we were just to do, let's close out all this math, and let's say that if the trade failed, you lost 2%. And so your $100 has become $98. However, if this particular trade succeeded, your portfolio is now at 110 because that's a 10% increase. And so that's just a quick intro. We'll go into more detailed stuff on compound interest, but this is a very common misconception. Risking a small percentage of your trade can still have you putting a lot of money into trades. It just forces you to make smarter trades. All right, so what I've got here is a series of trades set up. And so our risk to reward ratio in each of these trades says right here, this is a 2-to-1, this is a 2-to-1, and this is also a 2-to-1. And so that matches the examples we were just given, which is, this hypothetical trade plan has a minimum risk to reward ratio of 2-to-1. So that means that when entering this trade, you have the potential to make twice as much money as you would have the potential to lose if your stop loss was hit. And so let's say that for this example, and to make math easy, let's say that you are putting $100 on this. Your strategy is just to say, hey, I want to throw $100 at every single trade because, it's risk the same amount per trade. You have $100. In hindsight, that's not going to be true, but this is showing why that's important. And so for this first example, we have 7.79% potential gain, and so that would be $7.79 potential gain. Second trade has a potential to make 5.64. And this third trade up here has the potential to make 465. And so we can do the same thing for the losses. And so this has a potential loss of 389. This is, again, assuming that you're putting $100 on every single one of these trades. 282 for the second one. And 232 for the last one. And so if we do some quick math here, let me pull up a calculator. So let's say you won every single one of these trades. You would win 779 from the first one, 564 from the second one, and 465 from the second. All right, so you guys can't see my calculator, but that comes out to 1808 as a potential, grand total winnings for this. And we'll do the same thing for the losses. If we add, let's assume that every one of these trades went against us, and we lose those amounts, that would be a total of 903. And that makes sense because this actually matches perfectly our 2-to-1 risk to reward ratio, where we have the potential to make, roughly twice as much, or a couple pennies off. And so if every one of these trades went with us, we'd make 1808. If every one of these trades went against us, we'd make 903. And this is with the idea of we're just throwing $100 on every single one of these trades. And so let's see where this comes to be a problem. That kind of mindset of I'm going to throw the same money at every trade because all trades are created equal. And so let's assume that you're now, these are smaller time frames. Let's assume that you are now targeting a much higher time frame trade. Where you're zoomed out and you're saying, hey, this has the potential to run up pretty far. Rune has been a strong coin. This is going to jump up here. And so if we assume that the same thing, let's assume that this trade, let's assume that this trade goes in our favor. We have the potential of making 35.51, and the potential to lose 1774. And I did not point it out on this one, but this also fits our 2-to-1 risk to reward ratio as well. And so what would happen here, and just to kind of beat this to death a little bit, is just because we decided that, hey, we're going to throw the same $100 at every single trade. If you had won each one of these trades along this way, you made 3 consecutive good trades, then you have made 1808 profit. Fast forward to this one trade and assume that this one trade goes against your odds, and you've now lost 1704. And so this one trade by itself has wiped out your 3 other wins. And this is why it's so important to actually risk the same portfolio amount rather than throw the same entry value on every single trade. Because the difference is that this stop is just so much larger. Because this is a 17% stop loss, it would have watered down how much you can enter this trade with because your swing is much larger. And so if we play this one out a little bit, what we can see is that this, in fact, would have been a loss right there. And you would have given away all of your earnings back in this. And so this is why it's super, super important that we do standardize our losses. And so every loss is the same monetary value, as well as meeting our other risk to reward criteria.